Welcome back to Explain the Charts. Today, September 5th, 2024, we're looking at the USDJPY to see what's happening with the Japanese yen's recent rally against the US dollar. The news is indicating a strong bearish trend, with USDJPY breaking below key support levels and falling towards August 5th lows. Traders are advised to avoid adding short positions as the Relative Strength Index, RSI, is currently oversold. This downtrend is likely due to the divergence in monetary policies between the Federal Reserve and the Bank of Japan, BOJ. While the Fed is looking to keep unemployment low and inflation around 2%, the BOJ is considering ending its negative interest rate policy, NRP, potentially triggering momentum for the yen and ending 7 years of negative rates. Let's dive into the charts to see how this news is reflected in the price action. Firstly, let's take a look at the daily chart and see the big picture. We see USDJPY has been trading in a long-term uptrend, with higher highs and higher lows since early 2023. This trend has been supported by a widening interest rate differential between the US and Japan. However, the recent decline has broken below the uptrend line, suggesting a potential change in momentum. We can see strong support levels around 142 to 143, which could potentially stop the fall. However, if USDJPY breaks below these levels, it could signal a more significant bearish reversal. This could lead to a test of the 13-month low around 140.75. Keep in mind that the news of potential BOJ rate hikes could reinforce the bearish sentiment, especially if the U.S. economic data continues to weaken, leading to expectations of further Fed rate cuts. Now, let's zoom in and take a look at the 1-hour chart to see if we can spot any short-term opportunities. The hourly chart shows a more volatile picture with a clear downtrend over the last few days. The latest candle has closed below the 144 level, which was a significant support level, potentially signaling further decline. We can see potential resistance levels around 143.5 to 144, which might slow down the decline. However, if the price breaks above these levels, it could signal a short-term reversal. We need to be aware of the upcoming U.S. economic data releases, particularly the non-farm payrolls report, as they could significantly influence the direction of the USDJPY in the short term. A weaker-than-expected report could further boost the yen's strength, potentially pushing USDJPY towards 142. Let's take a look at the 15-minute chart to see if we can find any really short-term opportunities. The 15-minute chart shows a very rapid decline, with several bearish candles consecutively. We can see that the price is approaching a support level around 143.3 to 143.4. If the price breaks below these levels, it could signal a short-term bearish breakout. However, it's crucial to monitor the news and economic data for any potential short-term reversals. A positive surprise in the upcoming economic data releases could potentially push the USDJPY back up, making the short-term bearish sentiment less likely. To recap the important price levels, we have significant support levels around 142 to 143 on the daily chart. If USDJPY breaks below these levels, it could signal a more significant bearish reversal. On the hourly chart, we have potential resistance levels around 143.5 to 144, which might slow down the decline. The 15-minute chart is showing a rapid decline, with potential support levels around 143.3 to 143.4. A break below these levels could signal a short-term bearish breakout. Keep in mind that the upcoming U.S. economic data releases, particularly the non-farm payrolls report, could significantly influence the direction of the USDJPY in the short term. A weaker-than-expected report could further boost the yen's strength, potentially pushing USDJPY towards 142. On the other hand, a positive surprise in the economic data could potentially push the USDJPY back up. The news of potential BOJ rate hikes could also reinforce the bearish sentiment, especially if the U.S. economic data continues to weaken.